Change tracks and touch base with the management of Nalco. Case for a chat here being that FY19 targets and growth drivers are something the market is focused on. New smelting and refining capacity additions are coming on stream very soon, and there is perhaps some risk to margins given the volatility in raw material prices. So who better than Mr. T.K. Chand, who's the CMD of Nalco, joins in to answer all those risk factors. Mr. Chand, it's great to have you on the show. Thanks very much for taking out the time. FY18 saw you posting record gains, highest in a decade, thanks to a surge, of course, in international prices. Would this doubling of profits continue in FY19 also, or is it really a one-time wonder, so to speak?
Yeah, in FY19 also, our profit trend and also EBITDA trend will continue. In fact, in the first quarter itself, we are expecting that EBITDA will be somewhere around 30% because the average realization of alumina has been quite high as compared to the quarter 4. In quarter 4, we are having around $400 per ton of realization, but in this quarter it is expected to be somewhere around 540. So there is a significant improvement in the EBITDA, as well as we expect that part in this quarter will be almost doubled of that of fourth quarter.
Okay, that's encouraging to see. And here, supply disruptions in Brazil, however, Mr. Chand, still persist. Do you believe alumina prices will continue to remain at elevated levels?
Alumina prices have moderated. We have been getting around $600–700, but it has now come down to $490. And we expect that some supply improvement has been there. But we expect that alumina prices will be hovering around somewhere between 475 to 525. And this coming quarter, there will be some deficit. And in 2018 itself, there will be deficit in the market of the alumina supply, and it may ease in 2019.
Okay. You also have not signed any recent long-term contracts, Mr. Chand, for alumina supply, following or rather allowing you to take advantage of the rise in spot prices. Would this be a strategy going forward as well?
Yeah, because as you know that last 1.5 years, alumina market has been a rising market. So we thought that it will be better that we remain close to the market. And instead of making long-term contracts, we should make spot contracts, and that has also given benefit to the company. And always our prices have remained almost high as compared to the index of the market. So right now we are continuing with that strategy of making spot contract instead of long-term contract, and we are in a position to give because the order position is very good. So there is no problem on that account.
What about aluminum prices, and in the eventuality that the Rusal sanctions are relaxed, given that they have delivered shipments to some customers, do you see a significant downward spiral for the metal?
Even if sanctions are relaxed and Rusal come into the market, but still we expect that in 2018 up to end, market will remain deficit in alumina supply because in any case in Brazil Alunorte incident is still continuing, and Brazilian election is around October or November. So up to December such a situation is most likely to continue, that there will be some shortage in alumina market, and therefore prices will remain quite good. And if you compare the alumina prices and aluminum prices, growth in alumina prices are better than aluminum prices, and in a long-term contract, the percentage is linked to the LME. So therefore, once the LME is not growing, the alumina prices will not grow. So we thought that it is better that we continue with the existing system, and we are expecting that this will give result to us in this year, and next year we will be seeing that what could be our strategy.
Okay, you had witnessed a lot of volatility in raw material prices. Caustic soda was a big factor. Do you expect volatility to continue, and how are you proposing to stem it so that it doesn't impact your margins?
We are expecting that it will be already whatever prices we have obtained in our half yearly contract, it is around 10 to 15% more than the last year's level. So therefore it will have an impact. But at the same time, keeping in view that alumina prices in international market is quite good, so therefore it will get neutralized, and to that extent it will be satisfactory. And in the coming days, we expect that since the prices have gone quite high and international market has started moderating, we expect that caustic soda prices will a little come down.
Right, but could you give us some sense of where all you source your raw material requirements from, and how are you looking at kind of managing the cost base there?
As far as cost is concerned, Nalco is the lowest cost producer in alumina in the world, and in bauxite also we have become the second lowest cost producer in the world. So from cost point of view, the segment, bauxite and alumina segment, we are quite comfortable. In aluminium segment, cost is because we charge aluminium revenue segment with market price of alumina. So naturally the growth in alumina prices increases the cost of production in the aluminium, but overall, since the growth in prices of alumina takes place, so overall profitability of the company increases. But we are also trying to control the cost aspect in aluminium revenue segment. And one of the strategy that we have adopted, that we are bringing this coal block which has been allotted to us, Utkal D coal block, in operation in 2019 first quarter itself. So that will bring down the cost in aluminium revenue segment by 9,000 to 10,000 rupees, because right now we are supplying a part of our coal requirement through e-auction, which is quite costly. It is even more than doubled, around 2,600 to 2,800 more than the FSA coal. So that thing will get neutralized once our mines comes in the first quarter itself for 2019. That we are trying and putting it to operation. In addition to that small incremental gain in changing the work practices, then other small technological changes. But we expect that in aluminium segment next year itself, we will control the cost in a very significant way.
Mr. Shan, finally, during the last fiscal, you already achieved that 100% capacity utilization at bauxite aluminum refinery. How is it that you're going to ramp up the same in FY19?
In FY19, we have opened recently a mine, South Block bauxite mines, where we are, last year we have raised around 2 lakh ton additional from there. So our production was around 70 lakh, that is 7 million ton. It has moved from 6.8 million ton to 7 million ton, and this year we are increasing that to 6 lakh ton. So therefore, as far as bauxite production is concerned, there will be it will be little more than the 100%. It will go above. And in case of alumina production also, normative capacity is 2.1 million ton, which we have already done. And we are this year we are trying to put it beyond the capacity, maybe around 2.15 or 2.2, like that we are trying to take it. So that will be an additional production. There is a plan to bring a maximum of around 50,000 ton more in alumina. So these two things will help us in increasing the volume, particularly the alumina segment. And in aluminium segment, we have produced around 4.26. And this year we are trying to take it to the level of another 10,000 or 15,000 will add it. So some impact from the volume we are expecting, not a big impact, but small impact. But we are expecting that from the price point of view also, there will be impact, because margins to some extent will get neutralized by increase in the cost. But at the same time, because of the price factor in alumina and some growth in aluminium segment, because we expect that in aluminum segment, the average price last time we have obtained around 2100. This year we are expecting an average price of around 2200 to 2250, including the premium of 70 to 90. So that will give a growth, price growth, and a incremental growth in case of volume also. So both the things will be adding to our turnover. So we are looking at a turnover of around 10,500 crores and a EBITDA margin of around 21 to 22%, which will move from the existing overall EBITDA margin of 18% last year.
Okay, Mr. Chand, we'll leave it at that. Thank you so much for taking the time out and speaking with us today.
Thank you very much.